Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what we're seeing in the markets. As always, don't use these videos for trading purposes. They are for education only, information, review of what's going on. I always start here with the chart of the S&P 500 going back about 6 years here to just start of 2021 there on the left side. You can see the 22 bear market. And then after that, just as the Federal Reserve stopped raising rates, we had a nice rally here through 24, a little bit of a dip for sure to start the year for 25, and then off to the races again. And we are sitting at all-time highs in the stock market. Pretty pretty interesting. But yeah, we just follow the markets and what they're doing. As you can see here, here's a shallower long-term trend channel, big uptrend going on the weekly chart there. And then we move in a little closer. We put another trend line there to show what's happened here the last 6 months or so. And let's go look at this in a little more detail. We go down to a daily chart. You can see here that same trend line that I put up here, and some of our important moving averages, the 200-day moving average, the 50. We're above those and in an uptrend, as both the weekly and the daily chart are showing. Also put here near-term support for the market. It was that high from earlier in the year, right around the 61.50 mark ish. And then that's just about where we came back down to here. At end of July, had a pullback, so I'm marking that as our kind of support that we want to see the market stay above about the 6,200 level to remain in a solid uptrend. But it is certainly in that right now. We come back here to this is a 2-hour chart, and this gives us about the last, as you can see, 6 months trading, and you can see that just trend line. It's just been a slow grind higher here for the last several months. We've had starts to some sell-offs, certainly some news here and there that gets everybody excited, but the market just seems to want to forget it all and is just grinding its way higher, and that's what it's doing. We look at some of the internal measures, things are going on underneath the market. We have the bullish percent, which shows us the percentage of the S&P 500 that's in an uptrend. It's about 60%. As I showed in our last video, it hasn't really come off that number much. So you only have half of the stocks in the S&P 500 are making it rise. So we're getting that situation again where a handful of stocks are making the index go, because some people might not know that certain stocks are a much bigger percentage of the 500. It's not 500 equally weighted, as they call it. So you've got basically 7, 8 stocks that make up 20 or 25% of the index. So when Nvidia and Apple and Amazon and Google and Facebook, when those rally, the market's just going to go higher. It doesn't matter what the other stocks are doing, and that's what this sort of points out here, that it's really getting held up by a handful of them. The New York Advanced Decline line right here shows us a smoothed out number of how many stocks advancing versus declining. You see that's really been flat the last couple months, even as the market just grinds higher. So it's kind of not all the stocks are floating this boat, just a handful, which is concerning, but not always a timing issue that we could say, oh, the market's going to roll over, because that happens. It just shows a little weakness or confusion in the economy, or in the markets, I should say. Bottom one here, this is the VIX, the volatility index. This is the price that people are willing to pay for insurance, for protective puts in the options market to protect their portfolio. It's been down, really, just keeps staying lower, right there in the 14s, just has been sitting in the mid teens all month. So nothing to see there for concern. Look at some of the other internal measures that I like to look at, a ratio of consumer discretionary stocks to consumer staple stocks. That's been going strong. So people are still betting on consumer discretionary stocks, and that I should say, the stocks that, in the discretionary sector are still being bet on. So that's a good sign there. That's the same chart there. The technology over utilities. People are certainly, we're seeing technology stocks are outpacing utility stocks. Same thing, biotech stocks are outpacing healthcare. And then finally, hotels, the ratio of hotels to utilities, that's actually fallen right now, which is a little bit of a, canary in the coal mine, I guess. But you're not seeing anything on the price that's getting you scared just yet. So let's see. If we come down here, next thing to the interest rate on the 10-year U.S. Treasury bond. 4%. It's been in that same range here for years. We've just been sitting in this same kind of 4 to 5% range, hasn't gone anywhere. So very steady. That's good. Even in the last month or two, it's been coming down from the mid fours to 4. So that's actually can be helpful for the stock market. A little bit lower interest rates. We look at the economic picture, coming here to trading economics, and let's see, GDP growth rate, solid last print, 3.3%. That's good. Non-farm payrolls, the payrolls, jobs numbers, they're not. These are not good. These are barely above zero. The previous one had been 79. We're at 22 now. That those are just barely above zero. So we're not really seeing growth in jobs right now. And some of that can be disruptions in that, they're cutting government jobs and that private sector is catching up. Some of it, but not all of it. But still, that's not the best thing to see. Inflation rate, it's 2.9, 3. It's getting a little higher than we want to see, but it's still nothing to be concerned about as of yet. And then finally, retail sales is same thing, staying basically in the lower end of positive. Not great, but not anything to scream about yet. This is the one that's very concerning to me, which is the valuation on the stock market here. This line would show what I would consider fair valuation, 20 times earnings on the S&P 500. And you can see we're nearly double what that would be. So expensive market based on earnings. That there's no question about that. And that's the real concern. And for me, I also seeing this rally that we've had since the pullback in May has been pretty darn strong. And generally, when you have some big rally like that, you're going to see a pullback, but we haven't seen it yet. It looked like we were starting it here a few weeks ago. Maybe had a pretty bad week there, but the market bounced straight back. So all systems go still, and that's that we just try not to argue as much. I'm a little conservative right now. When we got that pullback and kind of haven't readjusted it as of yet. We're also a little news sensitive, I guess, with some of the tariff announcements and those sorts of things. But you can't argue with the fact that the market's telling you it's up and away. And it can do that for a long time, and we could be we don't want to be arguing with it. Put it that way. So hopefully this was helpful and informative. I'm going to go ahead and put up our contact information here if you'd like to hear more about what we're doing for client portfolios, or if there's questions that you have for or ideas for any of the next videos, please don't hesitate to reach out. As I said, hope it was helpful and informative, and thanks for watching. We'll see you at the next update. Bye now.